Most investors think they understand how exposed a company is to Bitcoin, but the second the price drops 40% in 3 weeks, suddenly every balance sheet looks like a house of cards. Let's slow down and actually audit this thing together, because the difference between a company that weathers the storm and one that melts down is almost always hiding in plain sight. The first place you want to look is on-chain proof of reserves. And yes, this is a real thing that exists and that most companies conveniently skip mentioning. Third-party attestations from firms that verify a company actually holds the Bitcoin it claims to hold are your first line of defense against what we could generously call creative accounting. Now here's where it gets a little spicy, because a company can technically show you reserves while simultaneously having a debt maturity schedule that would make your stomach drop. You want to pull that debt schedule and ask one simple question. When does the money come due? And is there any realistic way they pay it back if Bitcoin is sitting at $30,000 instead of $90,000? Concentration of revenue is the next quiet killer that almost nobody talks about until it's too late. If 80% of a company's income comes from one source tied directly to Bitcoin price appreciation, you are not investing in a business. You are investing in a leveraged Bitcoin bet wearing a suit. Think about it like a restaurant that only sells one dish and buys all its ingredients from one farm. Charming concept, catastrophic risk management. When the harvest fails, the restaurant doesn't just have a bad quarter, it closes. And that's exactly the dynamic playing out in companies that never diversified their revenue while the going was good. Historical liquidity of balance sheet assets is the check that separates the prepared from the panicked. You want to ask how quickly a company can actually convert its assets to cash, because Bitcoin can be volatile enough that a fire sale at the wrong moment doesn't just hurt margins, it can trigger a death spiral of forced selling. Here's the irony that almost nobody appreciates in real time. The companies that look the most aggressive and visionary during the bull run are often the ones with the least liquidity buffer when things reverse. Average realized sale prices, if the company actually sells Bitcoin, tell you whether management has been disciplined or whether they've been holding all the way down like a stubborn poker player refusing to fold a bad hand. Stress test scenarios are where the analysis becomes genuinely humbling, because the exercise forces you to confront numbers you'd rather not think about. Run the math on what happens to their debt ratios. If Bitcoin drops 50%, then 70%, then ask yourself whether the company survives all three scenarios or only one. On the qualitative side, custody arrangements and governance structures are the unglamorous details that become everything when something goes wrong. Who holds the keys? Are assets held with a regulated custodian? And does the board have any actual accountability mechanisms? Or is this a founder-controlled entity where one person's conviction is the entire risk management strategy? Now, layer in the quantitative stuff. Debt to asset ratios, the split between unsecured and secured debt, and perhaps most importantly, daily trading volume relative to their actual position size. If a company holds a Bitcoin position that would take weeks to exit without moving the market, that's not a treasure chest, that's a trap. The historical lesson hiding in every cycle is the same one we keep relearning at great personal expense. Conviction is not a strategy, and position size is not a personality trait. The companies and investors who survive volatile assets are almost never the ones with the strongest beliefs. They're the ones with the most disciplined frameworks for managing downside. Misconceptions run rampant here, and the biggest one is that on-chain transparency automatically equals safety. Seeing Bitcoin on a blockchain proves it exists, but it tells you nothing about whether it's been pledged as collateral 3 times over, or whether the company has layered liabilities that make the net position far more dangerous than the gross holding suggests. Ultimately, building this picture isn't about being pessimistic or dismissive of the opportunity. It's about doing the work that lets you participate with clarity instead of hope. And there's a massive practical difference between those two emotional states when the market decides to test your thesis at 2 in the morning. Discipline, sizing, and consistency are the only edges that actually compound over time. And the investors who internalize that early spend a lot less time recovering and a lot more time building. Whatever Bitcoin does next, being prepared with a clear-eyed risk picture means you're playing offense no matter the outcome. And if you're ready to put that same analytical discipline to work in your own financial life, whether that's real estate investing, home contracting projects, or connecting with the right lenders, check out our links in the description below and let's get started.